Hey everyone. Today we've got Patrick Karim with us. Wanted to bring him on, get some updates on what's going on. And obviously, my name's Andy from Finding Value Finance, and I'll be the host. So Patrick, over the past, thanks for coming on. Really appreciate it. Appreciate your
Thanks.
time. And it seems like to me over the past, I don't know, few weeks or so, we've seen a lot of movement in the markets, especially gold, silver. We've gotten a pretty big jump in silver here. Is it significant? Is it not significant? Are we breaking out of things? What are you seeing kind of in the markets there? What's your opinions around that?
All right. Yeah, it's always great to catch up with you. Like often people ask me, I'll do podcasts. I put some cryptic charts on Twitter, because the nuanced stuff we keep it for the members. But once in a while, I like either going on your show, or if I don't go on your show, I do my own podcast and just try to explain people like the bird's eye view, what I see. And yeah, we could dive into it there. I have a few macro charts I've been working on that I didn't publish. Maybe we could go through those.
Yeah, definitely. Anything
Share my
macro related, precious metals seem like they're breaking out. I mean, that's something I'm definitely curious your opinions on.
All right. Okay, let's start. Okay, let's start with the silver versus SPX chart. Okay, let's just start with silver, like just point blank. Let's do silver. Oops. Okay, not that. Okay, so let's look at the silver chart. Okay, I don't know how. Look, this is the quarterly chart, guys. And this is why you got to wait. Look, I don't know if we're going to have a chance because I talked to Kevin and says, Patrick, man, if we wait for the next quarter for silver to close in the breakout, it might be at the target already. It's like, you know how silver is.
Yep.
Well, I said, well, so be it. But right now, if we're lucky, we get a breakout confirmed that's not too far away from a quarterly defined breakout. Because look at this, look at these wicks. Okay, wicks, this trend line on the quarterly chart morphing into existence. Each of these wicks there's closes on the weekly, there's closes on the monthly, on the daily. There's a whole bunch of false breakouts on shorter time frames in these wicks, right? We hope, like, remember silver squeeze to the moon, like it traps. But look on the quarterly how tight that is. Tight. Even last quarter, remember we're above. I did that same chart last quarter because the candle was all the way up here. And it could have broken out last quarter. It could have. But the price by the end of the quarter, the price went all the way back down below the line. And look where it is today. Can I zoom on this thing? I can zoom on the Twitter images. Let me just put that back. But essentially, if we close Q3, so that's September, July, August, September close above this line, there's pretty much all the doubt. 95% of the doubt is removed there that this is it's off there, this rocket ship. You can have these type of moves, right? So that's a big picture for silver. We could go on the month. We could go on the okay, let's do silver on the monthly.
Like silver, I mean, are you waiting for that quarterly break to go long it, or do you buy before? I mean, obviously not advice, but are you waiting for the break? Is that kind of your approach?
It hasn't even, well, okay, if you don't want to wait for the quarterly, you got to at least wait for the monthly, and we're not there yet.
Okay.
So here's the monthly. Look at that thing. We're not quite there yet. It looks super bullish. Like, I know it's like you're about to win the race. Let's say you're about, or I don't know what could be a good analogy there. You're about to start the race. You're about to be the flag leader in the F1 race. It's not time to jump the gun. Okay, I don't know. You're gonna have to help me find an analogy, but we're about to start and win. Okay, let's say you're Usain Bolt. You're not gonna start running before the ref fires the gun, right? Because you'll get disqualified. You have to wait for the signal to go. It's almost there, but you waited 3 years for crying out. What's a month? Seriously, what can people wait a month to wait for get that confirmed breakout? Like, who knows? It could be a wick, man. Look, this. We'll show the evidence that could break down, and then you're trapped. You're totally trapped if you don't have sell stop. So you're very close. At the very least, at least wait for the 2 weeks. You have to wait 2 weeks for the close of July. Look, and if you get a close here, you're good. But there's so many clues, Cameco, a whole bunch of uraniums are like, there's stuff moving there everywhere in the commodity complex. Anything that measures destruction of purchasing power, they're off to they're doing good, right? So silver, very
What about like
close.
ratio charts? Could they tell us information before an actual break on a price chart?
Well,
Like a gold
they'll tell
ratio?
you, usually it goes, you want both, but I'll trust way more breakout an individual chart if I know that it's outperforming a competitor major asset class, right? If it's breaking out, let's say silver's breaking out on its price chart, but it hasn't broken out versus, let's say, SPX, I'm going to say, oh, you don't have 100% of the tailwinds because look, let's look at this chart here. This is silver versus SPX. There's no breakout at all yet. None. There's no breakout for SPX, for silver versus SPX. That's why you got to be careful. Look here, when it broke, when silver went bonkers in 2020, it had at least this bottoming pattern, multi-year, 2018 to 2020. It broke out. Then you said, okay, that's fine. But remember when we talked before the show, slanted, those over time, they become less and less slanted. And these, you trust them more and more. Look, this is how crazy it's going to be for silver price. The true bull era for silver doesn't start until here versus SPX. And the true one there, the reverse symmetry move, it's around this zone. This is a massive 10-year base forming. That's how crazy, this is how crazy it's going to be. I don't know where it's going to back test this line here. And the true end game move is that it's going to bring us to crazy targets for not just crazy targets, fast moves. Because you see how acute this line is. Okay, I'll just do a reverse symmetry move line. I'll put an angled trend line. How could I move this bottom thing there? That's annoying. Okay, here. Angle thick. So that's a 71 degree. And here I'll do 71 degree. I've seen these over and over, these reverse symmetry moves. They pretty much, the energy in pretty much tracks the energy out. So whenever silver closes above 0.008 shares of SPX, you're going to have a long move, a very high, fast move outperforming this SPX over a short period of time. You see how short that is? It's 2024 all the way to 2026. So it's a 2-year move that you just sit back, you buy the dips, you have the tailwinds in your favor. You'll practically not get triggered out. This as a trader, this is what I want to trap. Short, huge gains. Look, this, yes, it looks impressive, this move here. But look, it's not, this move here is going to be double the length of this move, of this tiny move here, right? What we're playing actually here is the bottoming. Anybody going long silver now is playing the bottom, a rally in a base. That's all you're doing right now because there's no official breakout. There's nothing, it hasn't even crossed this line yet. There's nothing happening right now. We're not even back at 2020 because we have to go back above this line to be back above 2020. But I'll tell you and here's the caveat. Actually, I'll overlay the silver chart itself. This is the illusion of fiat currency because I'm just going to move that up. When silver broke out back in 2020, right here, it started, or right about here, right where we are here, the same ratio. Look, we're at 0.0055. Silver was right here when we're about the same level. Silver was, what was that, $17 back then? Now the ratio, same point, but look at the price, $24. So a ratio, that means SPX also appreciated since those lows. By the time this move gets on the way, no matter, let's say where SPX is when we break out, it could be at 4,000, wherever it is, the nominal silver price could be much higher than it was back in, well, we know it's going to be higher than back it was in 2016. It's probably going to be higher. When it gets here, silver price, it's probably going to be higher than its 2020 highs. It's definitely higher than the ratio when the ratio was back here in 2006, right? Silver was like $11 back then. But the idea is no matter what the nominal value of silver is, you want to be outperforming the SPX. I'll tell you this, if you're not outperforming the SPX, why the hell are you holding silver? Seriously, why? There's no, okay, I understand the sound money stuff like that, but as a trade, if silver is going down here, let's say SPX, silver's breaking down versus SPX. Here it's breaking down. Why are you holding silver? Why? There's no reason to hold anything that's underperforming another asset class.
No, it makes sense.
Yeah, like I know the argument of ratios. If you absolutely, like we do it all the time with gold and silver. Like some people are sound money, you want to always hold gold and silver. Then you'll use a ratio chart, and you'll be able to swap. Well, you've covered this also. Like you want to be able to swap your gold to silver. You'll never sell all your gold, or you'll never sell all your silver to buy fiat. But you will sell all your gold to buy silver, and vice versa. But right now, if you had that theory for SPX or silver, you say, I don't want to hold fiat. I want to hold SPX or I want to hold silver. Well, if this ratio chart's going down, you know you shouldn't be holding silver at all. But we're getting close. It's like I'm going to get really jittery if ever it gets above this line here. That's a meaningful wall here, stalled here, stalled here. That resistance became support, support. Look at that resistance, resistance, resistance. Man, even by the time we reach this line here, silver could be at $28. I don't know where it's going to be. It depends where SPX is also going to be. It's really promising though. You really want those tailwinds. You want to be in a situation like you were back here there. This is what you want to be. You want to be in back in 2002, silver putting on bottom, breaking out, retesting from above, and that's what you want to ride.
That was I know they lowered interest rates after the crash in 01. They also had a weakening dollar during that time frame. The DXY was going down during that same time frame as well. I mean, we have the DXY that just fell off a cliff. It seemed like, so I'm sure the momentum's going down there. Do you think the conditions are right for silver to basically appreciate dramatically over the next, say, like, some years out based off of kind of the macro environment?
Yes. Look, and this is what people, this is what we have to remember. A lot of people remember the bull run of silver in the 2000s or gold, and it wasn't crazy high inflation back then, but it was primarily a DXY. So the US purchasing power essentially is the DXY. So the strength of the DXY versus the euro primarily, and then a few other currencies, adjusted for inflation. That's what gold tracks, and silver tracks the inflation adjusted version of gold. Okay, I'll just show a chart so people could visualize that. I did one recently. Just have to scroll down. I say recently, but I put out so many charts that recently it's like so far down. What the hell? Okay, where is it? Come on. Okay, here. This is gold versus CPI. Gold versus CPI is the black line. I overlaid the silver chart. That's what it is. Essentially, silver is a better play on gold's performance versus inflation. Gold, that explains, like when people say, how come silver's not at all-time highs, gold's at all-time highs? Well, silver does not track gold. Silver tracks gold's performance versus CPI. It's a better play. The true alpha play is gold. Why? Gold's at all-time highs way before everybody. Gold preserves your purchase power way better than silver, because silver is a derivative of gold versus CPI. But if CPI is going down, people think it's bad for gold. But think about a ratio. If CPI is going down and gold holds its own price, what do you think happens to the gold versus CPI ratio? It goes up, right? Yes. And silver tracks that. So even if CPI is going down and gold holds its ground, goes up, that ratio is going up. I don't care when I look at a ratio of gold versus PI, essentially it doesn't matter why it's moving up or down. Is it because gold's going up or CPI is going down? Like that mix doesn't 100% matter because for the silver price, because silver tracks the end result of it. It just happens that when there's a bull run, gold and CPI going up. It just happens that gold's outperforming CPI, pricing in, ahead of the curve. The CPI is coming up. And after that, gold peaks. CPI keeps going up. Then the ratio breaks down because CPI starts outperforming gold. It always ends like that. Gold peak in August of 2020 or whenever. CPI kept going up after, right? It made that ratio start going down. But gold had already put a nominal peak way before CPI peaked, right? So gold actually likes to bottom when CPI breaks down, which makes sense, right? Because that'll make that ratio go up. Gold stays flat. So now those low CPI ratings, I love them. I love seeing CPI going down because that's telling me, and gold's holding its price, it's telling me that it's going to start pricing in the next run of CPI. And as long as gold doesn't peak, that means it's going to sniff out. CPI is going to go up, 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 up. And with the silver track, silver track's exactly that. So there's some bullish looks, bullish line here, 1, 2. So that's a wake up line. I'd have to update this chart with the latest CPI ratings, but the MACD is bonkers. It's about to go bullish. Like the last time we've had these signals, they don't happen very often there. Here's one, false breakout, but look, 1972, 1977, 2002. So we want to talk about macro, man. This is, you're there. You look, okay, whether this is a fall breakout or not, put that aside. But we're not at a blow off top peak anymore. Look, this was a 2020 peak in MACD for gold versus CPI. We're not there. We're not at 2011 peak. We're not at 1980 peak. We're not 1974 or 75 peak. So I'm going to look for the breakout instead of the breakdown because it makes no sense looking for the breakdown at this stage because there's no blow off top. There's no FOMO. We have none of that stuff, right? So you got to wait now like a sniper and start looking at exactly where you want to go because the opportunity. And look, this is just going to be the first rally up. It's crazy what's going to happen, Andy. Whatever craziness we have here, silver price, just that run up to that paradigm shift breakout line, because there's going to be a resistance here. It's going to morph into existence. The true bonkerness, this could be in a couple of years. It's like,
well,
okay.
yeah, it makes sense to me. I mean, that it's out a little ways, which is good because then you have time to accumulate if you're a long-term investor. Like
look, this is what, like you want a 10-year run, you want to getting in early. It's like, it's now really, really early birds, but there's still a lot of time to position yourself. There should be no FOMO. And where was I going with that? Oh yeah, the macro. So yeah, the people remember in the 2000s, that run was primarily because the purchasing power was the DXY going down a lot in the 2000s. But now it's going down and there's inflation. And if ever it goes, even if the DXY starts to decide to go up, if inflation outpaces the DXY, then the purchasing power is going down and gold tracks that practically inverse. Look at this thing. This is the 10-year. I think before we started, we talked about this. So this is a 30-year divided by the 10-year. And essentially, this is the markets at discounting short-term inflation versus long-term. So the 10-year, it's my short one. So let's say people think there's a recession or something. The 10-year is going to start tanking. The 30-year should either stay flat or perform better because they think there's higher inflation. This is what happened recently in the past couple of days. I'll put on the daily. Look at that. Bam. That's violent. This is like what we had here. This is what happened. And that's when silver actually started going bonkers. And the markets are sensing something that they don't want those 10 years outperforming the 30 years that much. Something's happening here. And I'm going to overlay a chart, which can be kind of scary. Markets, US equities, they top out when this hits the bottom rail. Not always. I'll show you guys what happens when this. Here is the SPX. Here's the SPX 2000 bubble. Look at that. Bottoms and they start shooting up. Look at that bottom as in the 10-year versus the 30-year as the markets top. Bottom here in the, well, it keeps going up, but here when they really break out, that's exactly when the market topped in 2007. Here's another one, 2016. 10 versus 30. Here we had that small wake up. Remember, everybody was going bonkers here at SILJ. Everything went bonkers in late 2015, early 2016. That was a bear market rally for your gold. Well, that was that slight pause in US equities right here. Here, rates go up, get some volatility, but that was a top before the COVID, even before COVID, for that small melt up. It was topping here. I remember, 2018, right? The banking thing there, that repo thing, the first time we ever heard of that, late in 2018. Remember, put out a tweet, the guy in the treasury, I contacted the 6 banks, everything's under control. Remember that? And here, look, and here we are again. Here we are again. Markets are overheating. And that thing, if ever that line breaks out, then that could be tough for US equities. And look, where US equities, they like to bottom. They bottom when that thing tops. So as soon as that starts unwinding, it fuels US equities. Look at this thing here. As the 10-year, as the 30-year, so long-term inflation expectations versus the 10-year go down. Growth stocks love that because the cost of borrowing money, the margins, everything expands when less and less inflation is expected in the future. That thing unwinds, US equities go bonker. Look at that. Even here was actually exactly where there was the breakout in US equities, was when that thing started cascading down. Again, same thing here. 30-year divided by 10-year breaks down. Look what happens to US equities, bull run, etc. It's that thing's been repeating over and over. I could overlay the recessions often, but not always. There's a recession when this starts rocketing upwards. There's a recession, because I'll overlay another chart. And you could tell me if this initial claims, you could tell me which one's the roost, the egg, or the chicken. I'll remove US equities. I'll remove drawings. And this, okay, here is the 1030. Can I put that on the log scale? Okay, look at that. That's the initial claims. Look how well it tracks the US. I don't look at unemployment. Initial claims, look at that thing. This is telling me that the market's pricing in that initial claims. Something could be happening in the job market where, let me remove, I'll put just black thick. It's possible that the markets are pricing in that there'll be a spike in jobless claims going up. A recession, maybe, stuff like that, But again, when the jobless claims are rock bottom, there's no room for them to go more rock bottom. Naturally, eventually, if there's a breakout, you can't guess when that's going to happen. But if there's a breakout, it goes up, right? I'll show you a chart that tracks exactly these two charts.
Gold does really well when initial claims and that ratio goes back up. So gold and silver would be the spot to be during when that all increases.
Definitely. And look at that. This is I just have to get the best. Okay, hold on. Because of that COVID spike. Okay, here is okay, here we go. This is the initial claims. Look at that. I put the ASA fund, the Gold and Silver Miners Index. It's the oldest one I have there since 1977. I think it goes back older because, hold on, I'll put it here. ASA. Here, ASA here. And I'll put line to make it look better. Remove drawings. Okay, look at that. Here's the ASA chart. Even in the 70s, tracks the initial claims. So because, exactly, when initial claims rocket upwards, recession, what does the market price in? Destruction of purchasing power to save the economy. That's like, it repeats all over and over again. Either printing money, devaluing the US dollar, whatever combination it is, there's going to be more inflation. That's what the market prices in. As soon as it senses a recession is impending, it's already priced, it prices in. So the miners, gold, silver, they start pricing in the destruction of purchasing power because they're real. And look at the miners. Look, when I saw that chart, it just tracks it to perfection. These these moves up. Even here, the COVID spike. Well, not actually. Get my. Look at that. Look at here. Bam. The miners went bonkers when the initial claim. It's kind of sad because if you're playing the miners, you know there's going to be some pain in the US, right? It's like that's the game, right? Look at this. It's tracking it to a T. Look at this. The initial claims are about to rocket. That's what if the miners break out, the jobless claims are going to rocket.
Yeah, so basically what I'm seeing here is that we could have conditions that are similar to the 1970s.
Oh, Jesus. Look at this here. Here, the initial claims rocket. The miners go bonkers. Initial claims reset. Initial claims go up. Miners rocket. Look, it's not one for one, but that's why people have to zoom out and you have to look just at the overall trend. And you'll see here, look, here's a huge bottom here in initial claims. Oh, it's a Goldilocks. Goldilocks. It can never stop the US economy, right? Back here in 2000, before it imploded. Initial claims rocket, and there's a lag, but the miners went up. And even as initial claims resetted, the miners didn't quite believe it because at this stage, gold was breaking out versus CPI, gold was breaking out versus SPX. So even if the initial claims reset, the miners refused to go down because the market knew it was still shaky, right? And they were right because initial claims after that, they did rocket back upwards and the miners just kept grinding upwards. So that's a big chunk part of the evidence. And the 30-year TNX, TYX divided by TNX. It's the same chart. So essentially, here's the 10-year by the 30-year, and look at that. It tracks the initial claims. See that? It's like, so they're all that V shape we saw on the daily for the 10-year versus 30-year versus the 10-year rocking upwards. That's a market saying, oh my goodness, hold on. Somebody has to start pricing in that initial claims might not be as good, or they might break out eventually. Like that's what it's telling us, that V shape.
Yeah, because the 30-year versus the 10-year, that's just the yield curve inverting and uninverting, like it's going back and forth. And then your jobs are based off of a recession. So the curve uninverting would be a recession, and then your unemployment kicks up. But yeah. And that's when gold does really well. Gold and silver. It's the right market conditions.
It needs these jump, like these jolts, these recessions. But we could already be in a recession. Look, it's going to be backfilled. That's why, look, the recession indicator, it's fun to put on the chart. But seriously, we could have been in a recession if, look, I'll show, look at the miners, the bottom and the abyss of the recession. Look, jobless claims keep going up. Is that the, no, those aren't the miners, the 10-year, but I'll put the miners back up. Look at the miners here in 2008. They bottomed in the abyss of the recession, which was backfilled later, while the jobless claims kept going up. And even the jobless claim numbers, you know how it is, right? They keep revising that stuff. So it's not actionable data. It's fun to see it happen. We could be, look here, see the miners bottom the abyss of the recession. They bottom here, started turning up. Not always here, abyss of recession. Look here, abyss of the recession here, abyss of the recession. They bottom the miners. It's possible. Look, we could have had a recession here back in when the miners bottom here. Maybe not always. Doesn't mean we have to have had a recession, but the markets were pricing in when the miners were tanking. They were kind of pricing in the possibility that they, like, unofficially, eventually, maybe a recession would be triggered. But yeah, look, if the miners are going up, we're not in a recession anymore, or they could backfill it, but we're not at, look, miners going up, we're not at the start of a recession. That's what it's telling you of the miners going up. They're already pricing in the recovery. So if ever the miners break out, silver breaks out, we're not starting a recession. We're not, it's just not happening right now. Where, look, I'll show you the silver chart.
Is it pricing in potential inflation, maybe?
Well, it's pricing in the recovery. So this is key. Check this out. Silver nobody likes US equities going down. Nobody likes that. People think, oh, gold, nobody likes US equities going down. It's deflation. And if they keep going down too much, practically all the time, they'll drag everybody down. So I'll put here's the Dow Jones, MACD, and I'll put in the silver chart. Here you go. So look at silver. You see it bottoms here, but look when it goes bonkers. It doesn't go bonker here with the Dow going down. It goes up on the way up, pricing in the recovery, all the monetary imbalances required to save the Dow. Silver's, that's where it thrives. It doesn't thrive on, look, in the 70s, not quite. It had some periods where it went up even if the Dow crashed, but it doesn't want the Dow to go down to infinity, right? It wants it to muddle sideways, not break out on its own chart. Now I'll show you this. Remove drawings. Put down. Look at this here. Look at the MACD. Look how silver tracks the MACD, the recovery of the Dow. Right here, bullish cross for the MACD of the Dow. Below the zero line, this is critical. You see here, once the MACD of the Dow goes on the monthly goes below zero, that triggers the ding, 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 dings. It went down too much. It's went into the bearish threshold. It's going to need destruction of purchasing power to get reflated. And look at that. As that goes up, look what silver does. It tracks it exactly. It's bonkers. Here's the another bearish cross. And after that, the recoveries from below upwards, silver drives. As soon as there's a breakout on the MACD, it's game over for silver. So how come it's all the way up there, though? Something's wrong here. Oh, here's a chart. Something's skewed. I can't remember. I did on another chart. Was it the quarterly? Let me see. Is that SPX? On another chart I did, the MACD wasn't quite here, but here's a recovery. So if ever silver breaks out on its own price chart and this thing turns up, it's sniffing out the recovery and that's going to fuel silver. See, it did it again here. See, recovery, silver goes up until if it goes up, overheats, then the US equities, they don't need they're on their own. So this is another opportunity right here for silver to play the recovery. So silver is actually a recovery play when a lot of damage has been done, or too much damage, or a threshold of damage has been done to US equities because of inflation. Ah, well, look at this chart. This is key chart. You're right. So let's look at the SPX. And recently somebody asked me, are you bullish on this SPX versus CPI? A lot of damage has been done for the SPX versus CPI. So it's resisting pretty much. It's going up versus the Ichimoku cloud, kind of like in the 87s. But once you do that damage, people think it's V-shape to the moon. It's not quite. When you fall that much, what's probably more likely going to happen is eventually there'll be a either horizontal line or slightly slanted line, which is going to get discovered. Here's a wall, this topping pattern, support, and resistance. There's probably going to be a reaction here. Then it's going to coil down, then go up. Then the low risk, high reward opportunity for growth stocks, it's going to be what, in 2026, 2027, maybe later. But as that muddles sideways, this is a great environment for gold and silver. Look, here it was very severe, the drop versus CPI here, very severe, 2008, 2001. But it doesn't have to be totally like deep. Just need the US equities to underperform CPI. That means it's probably going to be underperforming gold, underperforming silver, and that's a good environment. So it's not time to be long growth stocks at all, even if they're going bonkers. They need to break out. This needs to happen there. One touch, two touches, then a breakout. Then you buy all the Bitcoins you could find, or whatever new fad is going to be when that breaks out. It's probably going to be, I don't know, AI or maybe something we don't even know about. So it's not time to go long SPX because it's still hasn't broken out. It's still in the sideways pattern versus CPI. So then you got to look at the other assets, right? Uranium, gold, silver, oil. Got to look at all that stuff and see which one decides to break out first versus CPI. If gold breaks out versus CPI, that's the winner. The whole precious metals complex wins. If SPX breaks out versus CPI, well, there's a high likelihood that gold's going to hibernate and you're going to need to focus more on growth stocks, you know?
Yeah, so that means that gold just accounts for the money supply quicker than the consumer price index. Is that a fair statement?
Gold accounts for the money supply faster.
That's why it breaks out first, and that's why gold takes off before the CPI. And then the consumer price index is just a lagging indicator that they measure from prices later on.
Yes, it's lagging. Yes, CPI, PPI also. It's yeah, they're all lagging. Yes, you'll see in real time with yeah, just nominally gold versus SPX. Just like, okay, we gotta look at that chart because this is another gateway drug, gateway drug, gateway chart. Look, gold's hasn't broken out versus SPX at all. It's actually breaking down here. Silver's looking a lot better versus SPX. It's a massive pattern morphing to these. We're not there yet. There's no here, maybe. Oh yeah, here, but even here, look, it looks like it's faltering. It's not. Something's up, man. It's like,
well, maybe it's the the resurgence of inflation, and the curve's going to continue to invert even more.
well, if the curve inverts more and goes upwards, this should go up because here, let's do the 30-year. No, TNX, no, TYX divided by TNX. It's that chart essentially there.
Yeah, it is.
Right, is that it? Where am I?
So that might be a leading indicator that the curve's going to invert even more.
What's wrong with my move to pin to new on the left? Okay, here it is. Jesus hell. Yeah, it tracks pretty much that chart, right? Look at that. Yeah. Well, look, we could look for leading or not, but I want to see some confirmed breakouts. Like, okay, let's just look at the gold chart. Remove drawings. Like at the end of the day, all we have to do is look at this chart. A lot of people hear that this is what they're looking at. So that's what I call the early early breakout line. But the truest breakout lines. Did I have it on the
what we saw in 2020 is they printed a bunch of money. Gold took off from March 2020 all the way into August of 2020. And then all of your laggards like oil and uranium and all that stuff took off September of 2020 when the yield curve started, when the money was printed, gold took off, everything else accounted for it later, like the consumer price index and all this other stuff as money rotated through the system, it seemed like. So if gold takes off here, it means that more money is coming into the system. And then I think everything else follows behind it, it seems like.
More destruction of purchasing power because there could be zero money coming in, zero, but the US dollar loses strength versus the euro and gold's still going to go bonkers, right? Because I'll show you something. I'll show you something here about the look. This is kind of look at that thing there. It's like it's borderline. Like that looks super bullish there. Maybe in hindsight, somebody's going to call that one a breakout, a semestral candle breakout. There was a high wick, so it's hard to trust that, but it's like it's super bullish. Look at this stuff, man. This is like textbook pull flag Like bullish,
Mhm.
bullish, 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 bullish. Who is bearish a chart pattern like that? I don't get it. I just don't. It's crazy. Pull flag, measured moves to the moon. It's like Jesus, That's like some 26, 2800, 3000. That's probably the profit taking zone. It's going to be there.
Mhm.
Like, what do you want? It could be violent also. Like, it could already be happening there. Look
So
at that.
if we see that, then we would see oil and all these other ones. They could also run with it.
It could. You need, they could. They could and they should. And I'm super bullish oil.
Me too.
XAG. Yeah. Well, look, well, I don't get it. Well, people are super.
I'm actually bullish everything we're talking about
Yeah. Well,
massively.
they all go hand in hand. Like I've overlaid the uranium chart, like they all track each other pretty much. If there's a bull run for gold versus SPX, or bull run for just a bull run for gold, it's a bull run for insert your commodity insert. Like, of course, I know some have cycles, but overall, if you zoom out on they're going to get the tailwinds because the money's not going to be going as much in the. I'll show you one thing though. Is it? Oh, we talked about money supply M2 SL. Can't remember if it's that one.
Mhm.
Okay, and I'll put my 7-year. I'll put my 10-year rate of change. Move drawings. Remove that. Okay, here. So this is like a fallacy that a lot of Bitcoin or US growth stocks, they say, oh, the money printer, they put the SPX. I'll show you what people do. That's what a lot of people do. Ah, Jesus, I don't have here. SPX. I'll overlay the SPX, new price cal. I'll put that on the people look at those charts and they say, oh, look, the money printer, it tracks, but they're just looking two lines overlaid one another, but they're missing the details. So while both are going bottom left to top right, and people say, oh, more money supply, growth stocks have to go along Bitcoin and whatever, anti-fiat. What you have to do is you have to look at the rate of change, because there's periods here where the SPX goes nowhere. Maybe a dividend adjusted, they're not that bad. And people got to remember, SPX is not the enemy. There's energy sectors in there, there's basic material sectors in there. And if somebody would look at what happens at the SPX during these 10-year hiatus, the energy sectors, which are probably like less, and basic materials, which are probably less than 10% of the SPX, or 5 at the start, by the end, there may be 15 or 20%, just like tech stocks in a growth bull run. Tech stocks start a small portion of the SPX and they end up being heavy weighted, right? I wonder right now with the tech sector, it must be at least 30% of the SPX, maybe more weighted if you weigh those 11 sectors. But while this line keeps going up, you see it goes sideways. While this line keeps going up, it goes sideways. So to see the details of that black line, the money supply, look at the rate of change. Look at this. Maybe that's too long. I'll put a 84, 7-year, 48, maybe shorter. I'll find one. So here, as the rate of change for money supply goes up, okay, this is critical. If the rate of change for money supply goes too fast, so it goes up, it's good for US stocks, but if it goes up too fast, the market has to take a step back and it has to come back to what you said. Money, too much money, inflation. Market said, okay, hold on. There's just, you went bonkers. Some of this money, I have to price in commodities because the fiat's getting destroyed. I have to raise the price of gold. I have to raise the price of silver. I have to raise the price of oil because you just printed too much at that moment. So check out what happens. I'll put the US oil chart. New price cal. And as the 10-year here's a 7-year rate of change goes up, oil prices go up. And then after the rate of change starts cooling down, oil tracks that. Oil tracks the rate of change of the M2. But oil is more than that. It's not just tracking that. The CPI because there's still the cumulative effect, right? So even if the rate of change is going down, oil is not going to go down to zero, because every year that the rate of change is positive, it, just like the year-over-year inflation rate, even if the inflation rate goes down to 1%, the CPI is still going to go up because it's a positive year-over-year inflation rate. But look at here, money supply breaks out, moves up. Look what happens to the oil price, goes up until it breaks down. Here, there was a slowdown, goes sideways. And what happens here when this goes sideways? That was the bull run for, or even here, it goes sideways. It's a bull run for US equities. And people are wondering why oil is going down. Well, look, oil is pricing in the slowdown in M2 money supply growth. That's exactly what's happening. If gold breaks out, we're probably going to know in hindsight that a lot of money printing is coming down the pipeline. The markets are going to start pricing in that thing, accelerating full throttle, right? And that goes in line with your, I could probably overlay on this, the 30 by the 10-year, probably looks like that. I could overlay the CPI inflation rate. Inflation rate probably looks close to that. I think it's exactly that. Remove drawings. Move that up. Look at the inflation rate. That's what it is. Yep. So if you want to prove that money, it's not money supply going up that creates inflation, but too much of it, the throttle of it, is what guides inflation rate down the pipeline. Look at that. Look, it's actually before. The inflation rate came after, Andy. It's funny, right? Look, there's a lag. There's lags.
Yep.
Look at that. The money supply slows down. Inflation rate peaks after. Yeah, so it's essentially the money supply growth that is driving this.
Yep.
It's not 100% like it's part of it, but it's a big part of it. And you see it right here. So now we just got to wait. If oil's holding its ground and oil starts breaking out, uranium's breaking out, gold's breaking out, all that stuff breaking out, it's pretty guaranteed thing that the inflation rate is going to go back up, and they're gonna have to open the spigots on.
Yeah, on the empty money supply.
Yes, look, it's about, and it's technically a huge base, coiling, higher lows, tight tide, breakout. It looks like a back test coming.
Agreed. Totally agree with that.
It just looks like a back test. That's why people are looking at the M2 and stuff like that. You're one step behind. Because it's fun to know it's there, but you're one step behind. The market, oil is definitely going to break out before the acceleration starts going. It's going to start breaking on the daily chart, on the weekly. They're going to start pricing in the probabilities of something happening, of the initial claims going up, of that 30 divided by the 10-year, like flip going back up, all that stuff. And the miners are going to start breaking out, so the macro charts people should look at are the ones at the top of the pyramid. I don't care about the secondary predators in the savannah. If I want to see the health of the savannah, I'm going to look at the lion. Is he getting fed? Look at the lion. The lion's gold. It's gold. That's all it is. And after that, its peers are the SPX, money supply, and that's pretty much it there. CPI to some extent representing this money supply growth. That's pretty much how we are there. So it's a back test, and it's very bullish that the 7-year rate of change for money supply is going to come and retest this. But the price of gold is much higher than it was back in March of 2020. It's a cumulative effect, right? Gold is not back at this price while everything's resetting. It's beautiful, man. Like, we're resetting the fuel, all the macro things that could fuel gold or silver. They're fully resetting, but gold and silver, they're both at higher lows than they were back in March of 2020. It's just textbook compound destruction, pushing of power. And as traders, we want to ride those fast moves up, right? We want to stay the shortest amount of time in a trade to maximize and outperform all that nastiness there that they're doing to your dollar, my dollar. Oh, the Swiss franc. We didn't even cover the Swiss franc. The Swiss franc's breaking out versus the US dollar. That chart, the Swiss franc, every time the Swiss franc is broken out versus US dollar, bull run for gold. Like, the Swiss franc is the best performing major fiat currency ever. it's like people say, oh, the US dollar is the best. No, the Swiss francs outperformed, destroyed the US dollar since for over 50 years. The Swiss franc has been the number one. So that's another big clue is the Swiss franc is kicking the US dollar's butt. And that's not bearish for all the stuff we're looking at.
I think that's when the last commodity bull market really started to take off in 0203. Swiss franc outperformed the dollar. All those things performed in the early 2000s, like 2002, I think, 2003.
Yes, look at that thing. So here, remove drawings, remove indicators. Okay, so this is the Swiss franc, hollow candles. Jesus, like the Swiss franc, the US dollar is definitely breaking down massively. Look at that thing. If it closes the month below this line, that's a horizontal. That's a horizontal, it's breaking down. And I'll flip the chart just so, and look at that. What does that look like?
Looks like it's ready to
That looks like
break
the gold
down.
chart.
Yeah, gold chart inverted.
Look at that. That's the gold chart there. So log scale. Look at that. It's the gold chart. So now you have, unless this fails, if this fails, it's gonna postpone. But that's telling us that there's a higher likelihood at this stage that gold continues its move up than it continues its move down.
Yeah, agreed. Totally
Look at, yeah, we're back here there. Look at it happen here. Jesus. Happened here. It happened a whole bunch of times in history where breakout, then it bull rally continued for gold. Just there's so much evidence there. It's like that's like I do that all the time there, and you do it also.
Is there any evidence that goes against the commodity bull market?
Well,
I struggle to find any.
yeah, you're making me think there. Look, I had a few scenarios where we could be in 1995. So in 1995, US equities kind of went sideways. And because of that SPX to gold ratio, which is not breaking out, actually broken down from that flag there. So you want to see that break out. If gold can break out versus SPX, or if gold breaks down, continues its downtrend versus SPX, while nominally gold can still go up, you got to ask yourself, why am I in gold? So that's the only thing I see there. It's like SPX still holding its ground, but it could be very close to turn. Seriously, I don't want to say the top sin for US equities because they're just putting month after month after month of white candles. I want to see like a wick. Like I want to see, like even Ripple went bonkers Friday or a few days ago. And now there's a huge wick starting to morph on top of that Ripple chart. It's back in its range. Well, no, like somebody said it was like not a security or something. Like, I don't care. That's noise. You got to take a step back, let the chart settle. And Jesus, well, look, if silver breaks down on its own chart, that's telling you a lot, right? That's telling you, oh, Jesus, it's like silver breaks out, gold's breaking out versus CPI, and that SPX to gold chart is probably gonna, that could probably be the bottom we saw on the gold to SPX chart, and it's gonna start a rally. That could be the bottom for that, right? Because I don't know, like in a hyperinflation scenario, gold and SPX are definitely going to go up together. Definitely going to go up together massively. It's just that one's going to go up higher than the other, right? Like Argentina, the stock markets, they're all bonkers. Japan, the stock market is bonkers. But when you measure it in gold price in its yen to account for destruction of the yen purchasing power, the stock market is horrible in Japan while it's doing nominal new highs. So that's another thing that could happen there. It's a scenario where SPX keeps rocking upwards and all the bulls, all those arrogant bulls there, SPX or the laser eyes, all these guys, they're going to have nominal price appreciation. But because they're not looking at the ratios, they're going to be missing out on the train that's going up faster.
Yeah, they're losing purchasing power against other assets. Totally agree.
Yeah, it's like I don't know. Look, we have access to ratio charts. Why not use them? It's like, why they're there. Nobody's using them. Seriously, I've interviewed people. You're the only guy who uses ratio charts practically, and some great chart traders. And if they would just look at the ratio charts, they would see that's what's driving all the capital flows, right? We've covered like 5 or 6 examples. The 30 divided by the 10-year looks exactly like the miners. The initial claims looks just like the 30 by the 10-year. The ratio chart of US versus Swiss franc looks exactly like the gold chart. Like, how many more examples do people want? There's not that many chart patterns out there. Like, I know in the classical chart, there's a lot of chart patterns, but a macro, zoom out 50 years, there's not many moving parts. Either you're long growth or you're long value there.
Yeah, you're basically looking at the leading indicators of what is causing things to move in the markets, which is yields. I totally
Yes.
agree. Totally agree. But then everything just blows off from that, like unemployment and all this other stuff.
Yes,
They're all
yes.
interconnected.
Like, I
Totally
listen to
agree.
some guys, they're good. They're able to put great narratives on these charts. Like, somebody, the 30-year divided by the 10-year rocking upwards. I forget who said that on Twitter. Says, oh well, that's the market pricing in that the Fed overdid it. You know, some people are great at putting words at what those charts to try to make more sense of what they're seeing on the yield curves, what's happening. It's
Mhm.
like, oh, they overdid it, and then that helps people crystallize that chart and the what's really happening under the wheels, right?
Yeah. Yeah, yeah, totally agree. Totally. I don't have much else to say that because I think I agree with that.
That's good.
So
Hopefully, your viewers get to see this and it helps them stop the fear mongering there. Look, I don't want to speak out too much against all those fear mongers out there, the manipulation, the bullion banks, and all that stuff, guys. Look, it could be true, could be not true, but who cares? You have to think about your family. You could bitch about manipulation, all that, but if there's a breakout, they can manipulate all they want. I don't care. I don't care about bullion banks. They're not going to stop me from buying silver when silver breaks out. I do not care because there's probably a bigger manipulator somewhere else. He's hedging his destruction of purchasing power hedge by buying silver, and I'm going to ride that. So, guys, please stay healthy in your brain. You don't need to worry about the comics. The comics is going to go long when the price goes up so much, they'll have to cover their shorts. That creates a buy, and they'll have to go long to ride the trend. That's 2 buys. So please don't worry about that, guys. I don't care about the bricks. I don't care about the bricks, guys. I don't. Like, actually, as a contrarian, I kind of find it bearish. Like, if silver is about to break out and has a confirmed breakout, and it's on the same day that the bricks falls apart, that is super bullish for silver. People don't realize it. It's like, I don't care for that bullish news because the market's discounting everything. And we've seen there's no chart on the bricks. But we've seen the charts. They track the yields, the yields, future inflation expectations versus short-term inflation expectations, and the damage it creates along the way, creating recessions. That's all it is. The market doesn't care about the bricks. There was no bricks in the 1980s. All that stuff's clickbait narratives that people spin around to get attraction. I'm not saying it's 100% nonsense. I'm saying it doesn't matter. In the grand scheme of things, that thing does not matter. It's not going to drive the price of gold for 10 years. Remember Basel? Oh, Basel, supposed to be this big thing. Basel came and went by. I didn't see that in any chart. What are we doing here? Sorry. Maybe you believe in the bricks. It's not that it doesn't exist, but
oh no, I'm not. I'm indifferent to the bricks.
yeah, it's indifferent, right? That's the way to see it. Just like indifferent.
Yeah, but I agree. It's I mean, they might be trying to attack our dollar, and then maybe we see the dollar just fall off a cliff, which yields. I don't know which way yields are going to break here. Like they yields. Yields are they usually follow the decline of the dollar. So dollar drops, yields drop, and then all the other currencies are stronger because they have tighter monetary policies than what we do. So basically, it's just graphing that we're crashing to
Yes.
some extent. And then
Yes.
gold takes off because it likes the real negative yield being larger. But yeah, it's everything that I see. It looks bullish for commodities. We just haven't broken out of this, like I'll call it wave 2 pullback yet. So Is that kind of the way that you see it? You just
Yes,
haven't
it's
broken out
close.
yet?
Yeah, well, it's very close. So again, uh, sleeper slant, trust less, trust more. Look, if you're not going to trust a horizontal breakout, then you shouldn't be trading, because it's not 100% that it goes to the moon, but you'll never get a better chance than, well, you see in my chart there, here, see like the gold breakout there in 2019.
Mhm.
Look, those okay, they don't come by very often, these patterns, and now we have a three-year sideways move. That's the second biggest pattern we've had in gold since that 8-year base we had from 2013 to all the way to 2019, right? So
Yep.
I mean, those opportunities, they come out twice in your trading career, 3 times. I was too young in the 2000s to trade, like in the early 2000s. Like I missed that, I started in 2006, but so
Mhm.
hopefully people will get aware that it's happening in the next few months, possibly there.
Yeah, and you also have that big horizontal line on the cup and handle for silver going
Yes.
the cup and handle for silver since
Ah,
the
geez.
1980 high.
There's so many beautiful patterns. Look, silver
Very worth.
kind of tricky because gold horizontal breakout line, but silver is so volatile and plays catch up that on an early breakout line, I'd play silver. I wouldn't wait for the horizontal, because it's, if gold breaks out of a horizontal and silver is breaking out of catching up from behind, go there. Don't need to wait for silver to. It's
The
gonna
rocket
go.
launch.
Yeah, well,
You
silver's
blink
gonna
and
go
silver's
where.
up and it is going to be up $5.
Yeah. Look, it's going to be bonkers. People forget how it was. Even in 2020, remember that day after day, 3%, 3%, 3%. Crazy month. It was like people forget. That was crazy stuff, man.
No, it was.
Silver has done that over and over, putting these crazy monthly bullish white candles there. It's like people are going to be chasing for sure. It's going to be
Yeah, it's
major,
going to be
major,
FOMO for sure.
but
Well,
there's no FOMO now though.
no, not right now. We're not there yet. Yeah, I mean, that's all I've got for questions. Do you have anything else that you'd like to add?
No, that's it, man.
That's it. All right. Well, thanks for coming on. I really appreciate it, Patrick. And if anybody wants to reach out to you, how do they reach out to you and contact you or follow
Uh,
you?
Bad Charts One on Twitter, all the free stuff. And if you like spending some money, go on northstarbadcharts.com.
Awesome. Awesome. So thanks for
Yeah.
coming on. Appreciate it. And
Thanks.
we'll catch everyone next time.
All right, man. Bye, guys.